Thanks for sticking with us through our previous two panels, one on the macro trends affecting industrial and retail, and one on the future of retail. Now it's time for our third panel on the future of logistics, and I'd like to welcome Austin, Juan, and Nicole. And let's go ahead and get started with some introductions. I'm going to start with you, Juan.
Thank you, Loretta. Juan de Angulo, managing partner at Elian. We're a vertically integrated platform focused in the logistics sector.
And Austin.
Hi, good morning. Austin Carmichael with the state of Oregon, investing on behalf of Oregon Public Employees Retirement Fund. We've got about a $10 billion total real estate program and have been very active increasing our industrial exposure the last couple of years.
And Nicole.
Hey, good morning. Can you hear me?
Yes, I can. You sound great.
Okay, great. Perfect. Sorry, I'm a little headset issues here. Good afternoon. My name is Nicole Welch. I am a managing director with Clarion Partners. I oversee our industrial asset management platform in the Western US. I've been doing this for about 18 years now, and it's just been really fun to watch the industrial sector mature and become such a coveted and high-performing asset class.
Thank you all for joining us. And again, for the audience, we are continuing to take questions through the Q&A button. So feel free to submit those and I will be posing them to the audience, from the audience to our panelists. But the first thing I might want to start off with is taking a look at some of the most attractive industrial subtypes for investment, what those might be now and in the future. And Nicole, I'm going to start with you and then I'll go to Juan and then Austin, okay?
Sure. Look, I think we've really seen how malleable industrial can be. I think that, you look at what we can do within the four walls of industrial building, right? And in my industrial portfolio, we have sound stages, we have life science, we have R&D and lab space and advanced manufacturing in some of our tech hubs. And so I think that, the list can go on, but the attractiveness of industrial and how we're designing buildings is really, in the inherent flexibility of the variety of uses that can be performed under the industrial umbrella.
What?
Well, I echo Nicole's comments in terms of some of the interesting uses that can come about. I'll focus my remarks more on the location of the assets in terms of how supply constrained they can be. We continue to find that extremely attractive and the resulting rent growth that we're seeing on the ground, especially given the macros today. We continue to see that as the subtype that really drives our investment behavior.
And are there any particular geographies that you'd want to point out for this? Is it port markets or anything in particular, urban?
Sure. I mean, where we find the supply constrained the most is obviously in the coastal markets, East and West Coast, and in the gateway markets that we could all probably guess, but such as New York, New Jersey, and DC, South Florida, Seattle, San Francisco, and Southern California. We continue to find very compelling supply and demand dynamics in those markets.
And Austin, thinking about this from the investor perspective, where are you finding the most attractive investments in the industrial space?
Yeah, I would echo what Juan just said. I think we certainly find the coastal markets attractive. It kind of mirrors and echoes where the population growth is a big part of that. Obviously, the ports and all the issues that everyone is aware of getting supplies in to the U.S. So, I mean, those areas that we find most attractive.
And one of the challenges that people are facing is maybe sourcing compelling investments right now. It's a bit of a hot market. How do you think about that? I'm going to start with you, Juan, and then I'll go to the other panelists.
Sure. I mean, look, it's an old adage of relationships, right? Obviously, anything that is stabilized and that is being marketed, it's going to garner just a absolute top price. It's hard to sort of track what that is these days. It's so dynamic. So we just really focus on being very on the ground. We have focused in building a very nimble platform that can allow us to do that. Our acquisitions team is very use driven in terms of the ultimate uses that can be given to a building. So sourcing in these last mile locations, you don't have the luxury of building or of buying buildings that would be probably what you would build today. And so having a real understanding of what the uses can be is very important, and just sourcing it directly, going directly to the business owner. Maybe it's a private owner, maybe it's through a leasing. I mean, there's a lot of different ways to try to get to the asset, especially when they're smaller in total dollar, where the larger aggregation of capital that's occurred looking for core and core plus type returns is looking more for portfolios or larger assets. So it's more an art than a science, I think, even though we are very data driven and we try to obviously fundamentally justify every decision we're making with a lot of hard data. But anyway, a lot to unpack there, but it's not easy. It's very difficult.
Nicole, I see you nodding along. Additional thoughts?
Yeah, no, we're paying up with Juan. So, I look in the core markets right now, particularly in the port cities, it's just challenging, right? It's highly competitive. We're paying up where we feel that it's accretive to our existing portfolio, where it's markets that we believe in long term. I think we've been able to seek some good yield and development. It's not without its challenges, but we're not adverse to taking on a little bit of entitlement risk or maybe a little bit of environmental hair on the site. I think anywhere that we can, develop right now, we're doing well. We're following our tenants too. And I think you heard a lot about that on the first panel this morning, right? Was really kind of watching where your tenants are going and new trends in that area. And with the labor constraints that we're seeing in these coastal markets, we have heard from a lot of our tenants, hey, look for us in more second tier markets next year. That's where we're going to be expanding our footprint. Because when you're having to hire thousands of employees in one tranche, I think that's why markets like a Phoenix, Reno, Vegas have been performing really well. So yeah.
And Austin, as an investor, how do you sort of think about this issue of sourcing? And is it something that you're actively speaking with your investment managers about, how they're handling that?
Yeah, it's obviously a challenge for everybody because everybody wants more industrial. We're doing it primarily through separate accounts is how we've approached our exposures. And that's been done kind of picking one off. So we've tried to avoid buying big portfolios, paying the premiums for that, although it feels like everything's you're paying a premium for anymore today. So it's really, just being, very diligent with our managers, finding things. And I think the focus would be to really just make sure we're picking assets and markets and submarkets that we believe in long-term. So that even when we're paying, a nice premium from historical standpoints on these, pretty low cap rates, it's assets that we believe are generally going to be very difficult to have competition, right? I mean, supply is the ultimate, party pooper for all the real estate. So if we can find assets that are going to be insulated somewhat from future supply and markets that we have, high growth expectations on, then we're comfortable paying these prices for this because we really are looking at it from a long-term perspective. Especially in our separate accounts, our core, we're looking to hold these things for indefinite periods of time. So if they're relatively bulletproof from the supply and the location standpoint, that's where we get comfort around that.
Nicole, you mentioned entitlement risk, and I have a question from the audience that sort of dovetails into this. Some markets have higher entitlement risk than others for development. In high infill markets with inflexible entitlement processes like the Bay Area, what do you see as some of the solutions to the logistics supply issue? Many industrial submarkets are already far out from urban centers. Do you see this gap getting even larger?
Yeah, I mean, look, my backyard is California, so I understand it. Probably one of the most litigious environments in the country. I think it's really understanding the municipality in which you're operating in, like really seeing who's developing around you in that particular submarket, in that city, understanding any uses that they're adverse to, right? If they're more labor driven, or if they prefer to see some kind of a CUP for manufacturing, it's just really knowing kind of what that city's objective is, and knowing how you're going to fit into that market, and again, how your product's going to fit into that market. Because if you're looking to build pure play distribution in a market where it's more advanced manufacturing, you may see some entitlement challenges. I think later on in this conversation, we'll get into sustainability. We're having a lot of conversations around that. Cities are definitely more in favor of industrial developments where they see mature landscaping, where they see solar, where they see bike paths, EV charging stations, things that are all, not an adverse impact on the environment. So I think it's just really understanding the municipality in which you're trying to build and forging those relationships with the cities.
Juan, do you have any on entitlement risk?
Sure, and we do have a sleeve of capital that focuses on development, and obviously finding land sites in these difficult markets is very difficult these days. And we're seeing an increased amount of activism on the part of certain segments of the market. They want to understand what the truck flow is going to be. They want to understand what the noise impact is going to be. I agree with Nicole that anything that you can do to show an awareness to ESG is going to be extremely important going forward. And we have done it in the past, and we will do it again. I think you have to build a relationship with the community and with the city or the particular jurisdiction, and really understand what is the risk you're taking, because ultimately it's about risk-adjusted returns. So absolutely.
When you think about investing in the logistics sector, whether that's acquisition or development, what are some of the location, size, and design trends that you see kind of developing in the future? I'll start with you, Juan, and then hit the rest of the panelists.
I mean, some of the things that we focus on is, we've mentioned the supply and demand already. I really don't like problems that don't have a solution, and I'm still trying to find what's going to be the solution for some of this supply and demand dislocation. Technology seems to be an answer to a point. I think technology is probably going to solve more of some of the labor concerns. So that's something that we look at, is how can we bring in technology to help us alleviate some of the pressures on labor, because obviously our tenants are going to continue to want to be close to the rooftops and continue to reduce their transportation expenses. Obviously parking, right? I mean, it's just such a big part of the problem for our tenants. We think you might see some more multi-level out there in some really dense urban areas. I think the jury's still out in how much that's going to really become a norm. I don't know how excited jurisdictions are going to be about multi-level warehouses and doubling up some of the density of trucks in some of this infrastructure, but that could be there. So those are some of the things that we focus on.
Yeah, when I hear about multi-level warehouses, I think Tokyo. I don't think Dallas, but Nicole, what do you see are some of the location, size, and design trends of the future?
Sure, I'll tackle location first and then design. From a location standpoint, and I said this previously, but I think it's really important, it's how does your product fit within that market, right? If you're developing in the Inland Empire, which is big box, brand new, larger footprint, best in class facilities, you want to be really competitive in that, particular arena. If you're in the infill markets, it's all about throughput, it's about doors, it's about yard, it's totally different parts of the building that you're seeing users really scrutinize over. So it's just knowing, how your product fits within the particular submarket that you're operating in, and making sure those attributes that are most valuable to the tenants, where they're going to pay the most amount of rent, are available. I think from a design standpoint, I have never heard in my entire career, I have never heard us on the industrial side talk about attributes of the facility and how they impact the employees in the way that we conventionally do in office, that we do in retail all the time, right? It's all about consumer experience. For us, though, our tenants, I think they're caring more and more about public transit. They're caring about commissaries. They're caring about light in the building. You're seeing higher and higher percentage of office being built within the warehouse. outdoor lunch amenities, patios, you've seen bocce courts in industrial. It's crazy. So I think we're much more concerned about the quality of the work for the labor going into the warehouses.
And Austin, as an investor, how are you thinking about some of these questions?
Yeah, actually, I think Nicole had a great point that we're seeing as far as labor being a big driver as a need to fulfill these. You can't just build a box out in the middle of nowhere if you don't have any workforce to get out there. You still need bodies out there in these warehouses. So we are starting to see that as a trend of more amenities for the workforce, making it more attractive to attract actual workers in these facilities. And I think that's going to continue, especially as labor continues to be tight, and see amenities kind of add-ons.
Just a reminder to the audience that you can submit questions. I have a few that I'd like to pose now. One of them, and I'll ask all of you this question, how have you seen industrial development change to capture the changing landscape of technology? How are you seeing technology on impact on the development side? Nicole?
Yeah, I'll take that one. Look, I think as these tenants are investing more and more dollars into the facility, right? When you have $50 million of spend through material handling, racking, you name it, going into a facility, it's all about redundancy. I think you're looking for redundancy in fiber. We're seeing more and more conversations around that. If the system goes down, do we have a backup for it? I think power is going to be huge, right? And it's been tougher and tougher in a lot of these municipalities. You can only pull so much power into the building without the tenant demonstrating that they need more. So it's making sure that you're maxing out on getting as much power and flexibility in that design as you can. But yeah, IT rooms are the first things to be built in the facility, and secure, fully secured yards to make sure that their expensive product is not going to, be subject to theft. Everything in that arena that touches technology.
Juan, do you have any more thoughts on technology, especially on the development?
Yeah, the only thing I would add is definitely, and Nicole mentioned it earlier, the focus on EV equipped new construction. I mean, definitely we see that coming, or it's here, being able to provide that to the tenants, and the focus on security. We've seen a lot of that as well.
Austin, any other comments here?
Not too much to add on to those, no.
Here's another question coming in. How have tenants responded to these sort of historically high rents that we're seeing in the industrial market? We got into talking about the high valuations. What are some of the tenant responses right now, and where do you see that going in the future? I'll start with you, Juan, and then I'll go to Nicole.
I mean, I can't tell you that they're happy about it, but I think tenants are they're very aware of what's going on. And I think, obviously there's been a lot of talk of inflation out there, and what the reality is that it's going to be in terms of its permanence and its total impact. And when you think about inflation, you think about a lot of things that impact the total cost of distribution. That's not the rent. And it sort of just puts even more of a premium on being close to the rooftops, and the willingness to pay continues to be there and go up. So if anything, we see tenants being extremely aggressive in wanting to secure their location. They're even starting to ask for longer terms in some of these places, and that's a decision for us, because your risk adverse portion of your being wants to say yes, but then in terms of understanding where the trends are going towards, you kind of wonder what's the best decision long term for the asset, and continuing to hedge against inflation. So I think tenants understand it, and I think the tenants that don't absolutely have to be close to the rooftops are taking advantage of secondary markets, and they're going to be farther and farther away from the urban center. But the ones that need to be there are stepping up, and they continue to step up.
Nicole, thoughts on this?
Yeah, no, I agree with Juan. I don't think any tenant you talk to is, doing jumping jacks over the fact that they're having to pay these rents. But at the same time, going back to what Melissa said on our first panel, I think a tenant's worst day is when they don't have the space, right? So if it means that they're going to have to forego paying a couple extra pennies in rent, they're not going to love it, but to secure the space and to have that available and be able to receive the product and be up and operating and mitigate any risk of getting into the facility, that is most important to them. And I think we talk about it all the time in industrial, right? Is what percentage of the total spend in the facility does real estate make up? And it's somewhere between 4 and 5% of the total spend when you compare it to labor, to transportation costs, et cetera. So in the, especially in the tier 1 markets, just kind of the cost of doing business, I think they're passing it through to their customers as much as they can. But again, their focus is on having the space. And I think I have to give, kudos to our brokerage community and to, my asset management peers. I think we're doing a really good job in sharing information and explaining, the narrative and telling the story of what is happening real time in the market and making sure that information is very, fast moving so that when you walk into a negotiation with a tenant, they're not totally caught off guard thinking that the rent is 20% lower than they were expecting. They're aware of the comps going down and they understand that it's a competitive environment as it is on the buy side.
Anything to add here, Austin?
Yeah, it's like we've heard some stories of some of our tenants who are getting sticker shock when they do see these renewals. And so some of our tenants we've heard that will take a pause, they'll go shop around a little bit and come back and say, okay, we know this is the market. Like it's like some of them are getting educated the hard way of what the market is, and that there's just no other options for many of them. And so yeah, like as Juan said, they're not thrilled with it, but it is the cost of doing business, unfortunately. So
yeah, they go out, they get a second opinion, and well, they're not going anywhere. I have a question.
And actually, Loretta, if you don't mind, I'm going to add something that Nicole mentioned is true. I think the brokerage community in these tight markets in industrial, they're very professional, they're very active, and they're educating their tenant base. And I think the best ones are proactively telling their tenants to come in and do an early renewal, because if they wait, it's probably working against them. So that's a very important point, that it's sort of taking everybody to come together professionally and share information and build a collective good out there.
And like I said, I have another question coming in, but with inflation being how it is right now, how are you handling options on a lease? And I'll start with you, Juan, but maybe everyone can kind of talk about how that's being handled.
I mean, look, generally speaking, we believe in market-based renewals and options. It should be an option to extend that market. It could end up working both ways depending on how the market is doing. But obviously, given the nature of these locations, we believe that that's what it should be based on. And I think locking something in doesn't make sense. So that's how we're handling renewals right now. And so far, so good.
Nicole?
Yeah, look, it's tough, right? Because a lot of tenants are starting to come to us 18, 24 months out. And if I could tell you that I could predict the rent 18 to 24 months out from now, I should probably be doing something different with my career, but I don't have that, that crystal ball. And so we're really trying to make sure that we're within the option window with tenants where we can be. I understand, the bigger players that have huge investments in these facilities are going to come to us early on. So I think then it's just, having a really good pulse on exactly where market is, collaborating with our research peers and making sure that we're applying the appropriate rent growth factor to, any predictive rent that we're trying to, come to a consensus on a year, 18 months out. But we're in a perfect world, we're trying to stay within that 12-month window.
I know, especially if you go, internationally, you see a lot of CPI linked lease terms. Is that common in the U.S. industrial leasing?
Not really. It's a fixed bump structure. Right now, I think historically, it's kind of been around 3%. We're starting to see those bumps, tickle up. We're looking at 3.5%, 4%. We've seen as high as 5% for some small shallow bay product in LA. It's certainly not the norm, but I think we're starting to see some upward pressure on annual increases for sure.
Anybody else want to weigh in on that?
Yeah, we're hearing the same thing with our partners, that it tends to be a fixed Historically it's been 3%. And yeah, some of our partners in some markets are able to push that a little bit higher than that, but that's generally how it's been.
And I have another question from the audience on development in urban infill. If you were to find an older, less functional property in an urban infill area, do you see clear height, dock doors, loading, or any other factors being a major issue for potential tenants? What do you look for specifically in these locations? And what tenants are you seeing in these urban infill locations? And I'm going to start with you, Juan, and then I'll go to everyone.
So the question is centered around developing in these urban areas, right?
Or acquiring. Actually, it sounds more like it's acquiring. If you find an older property, if you find an older, less functional property, is the fact that it doesn't have the right clear height door,
right.
Is that an issue?
Right. I mean, look, we're I don't know if it's ever going to become a word, but we talk a lot about the funkometer and how funky are the buildings, right? Because they are. I mean, when you go to the boroughs of New York, it's unusual buildings, and so you've really got to be comfortable understanding what tenants need. And it's not really ceiling height. I mean, the clear height of the building. These are quick throughput buildings, like Nicole was mentioning, and so that's not a huge priority. But the flow of goods has to work for them. They have to have an ability to receive and deliver the goods to their dispatch. So it's not one size fits all, and I think that's the biggest challenge, right? And when we're doing ground up development in a very nice green pasture, we all know what we need, the turning radius and dock doors, but these are unusual situations. So it's all about them being able to have throughput for their product.
And what are you specifically looking for? So you're looking for that. And what sort of tenants do you see in these locations?
I mean, there's a lot of, it's all at the end of the day distribution, right? But like Nicole mentioned earlier, other than distribution of goods, whether it's food or whether it's raw materials or any other type of good, we are seeing some other uses that are quasi service to the community that need to be close to the.
Oh, did Juan just freeze there for a second?
You froze for a sec. I'll jump in.
Thanks.
No worries. Look, there's something for everyone, like Juan was saying, right? When you get into the urban infill markets, again, it's how do you compete within that submarket relative to your peers in the competitive set, right? So if I'm looking at older antiquated product in, infill LA, what is the profile of users? You're going to see a broad spectrum, right? It may be a small manufacturer, it may be a startup, it may be a local wine distributor, it could be, a retailer. You're probably going to compromise a little bit on credit, right? It's going to be more regional credit in nature. I think that it's going to be, certainly smaller scale. I think clear height is if you had to rank them, right? I think clear height is probably less sensitivity. I think doors, throughput, yard, proximity to the population, access to the building from the street, how close are you to the nearest on-ramp, or what does the roof count, look like around you? It's just going to be a different profile. And if everything kind of looks the same around you and you're still 1% vacant, well, then that tells you something, so I think it's just how you fit within that market.
And we'll give Juan a moment to come back in, but Austin, do you have any thoughts on urban infill?
Yeah, I think actually I think Nicole really summarized it really well, which is understanding what the demand there is in that particular market, and a lot of funky stuff, to borrow a term from Juan, actually does work. It still works because it's located in an irreplaceable spot that you. There's cases where we have actually redeveloped some items or some product because and got it more modern, but more often than not, it doesn't quite pencil out and doesn't quite make sense to actually redevelop these super infill locations, and you can actually make older product still work because the demand is there.
And looks like Juan's able to join us again. Do you have anything else to add? We are adopting funkometer as a term, and we are discussing how funky these buildings are.
Yeah. I apologize for the technical difficulties, but the tail comments that I heard from Austin, I think it's going to be tough to find buildings that you can tear down. Just the pricing is just going to be very difficult to envision tearing them down, or honestly, the need for it. I think tenants are becoming more and more flexible to be able to use these locations as long as they're close to the rooftops.
Something that Nicole mentioned early on that I'd love to go a little deeper on. I'd love to talk a little bit about sustainability. How does sustainability and ESG, how does that fit into the logistics space of the future? And I'm going to start with you, Austin, because a lot of this is driven by investors and what investors are looking for. So how are you thinking about sustainability related to your investments in the logistics space?
Yeah, it's kind of tough, I think, for us to really wrap our heads around on within industrial. Probably the location would be one area that you would want to make sure you don't have excess carbon consumption for just transferring goods back and forth. Rooftops would be one area of some of our partners have looked into whether you can get solar panels on the roofs of these to kind of feed into the grid. And then, of course, just the construction of them. If you're doing ground up development, that's probably the easiest area to take on. But the efficiencies of these buildings is, and try to maximize what you can there. But yeah, I'd say it's an area that we're thinking about more about, but it's an area we probably frankly need more thought about how we would especially some of these older buildings. It's hard to reposition these things in any way that makes economic sense.
When you are working and talking to your industrial managers, is it a question? Are you sort of starting to ask this question about sustainability, and are you asking more than you have in the past around this topic? Austin?
Yeah, we are. And I think one area, it's really a matter around risk too, is around that we're starting to track is like floodplains and different high weather events that can occur. So that's an area that we're tracking more and paying more attention to.
And Juan, do you have some thoughts on how sustainability fits into the logistics space of the future?
Sure. Actually, ESG is something that has always been very important to us at different levels. Specifically speaking about sustainability, we actually signed up for Measurable a little over a year ago. So as of next year, we're actually going to have a baseline year, and we're going to be able to start to report. Because I think, anything that you can truly do to be able to have an impact on sustainability must be data driven and data backed. And so what we want to do is try to identify opportunities of impact, especially in these infill locations that we were talking about, where it's not probably obvious on how you can go about doing it with newer development, whether it's LEED certification or other things that you can do in new development. In these older locations, we're trying to really be thoughtful about it and gather the data so that as of next year, we have a baseline that we can actually report to GRESB and other actions that we're a part of, so that we can become proactively participants in creating sustainability in industrial.
And Nicole, I know you touched on this, but I'd love to hear some further thoughts from you.
Yeah, no, we're in the same boat as Juan, right? I think we're hearing about ESG everywhere you look, whether it's from the tenants themselves. I think if you are a developer right now and you read through your conditions of approval on any recent development project, what they're asking of you, what the city wants, what the communities are asking for, you're being held accountable. It's solar, it's, walkability, it's EV charging for autos and trucks in the future. A lot of our tenants have their own sustainability and green initiatives, right? They're looking to lower their carbon footprint, and real estate is a bucket of that. We've got 2 buildings in my portfolio right now that are seeking LEED Gold certification, which in the industrial world is a bit more rare. But I think it's certainly first of mind for tenants who, have any kind of sustainability reports that they're reporting to their investors, and they're trying to figure out where within their operation they can improve, right? Whether it's better packaging, sourcing of materials, et cetera. And real estate's just one of those buckets. So I think we're going to continue to hear more and more about that. And it's certainly on all our RFPs for, investors as well, particularly our European investors, where it's been front of mind for quite some time.
And I actually have a question. I actually have a question come in from the audience asking about this. Do you see tenants emphasizing their interest in a sustainable building? Given that LEED and other ESG costs can be significant, outside of being environmentally friendly, do you see any secondary benefits to being ESG and LEED friendly? So perhaps with tenant attraction or something like that. I'll start with you, Nicole.
Yeah, we do. It's a tenant request, absolutely. And you can only spec so much within LEED, without the tenant. It's really in their TI where you get into the meat of the LEED and your points. And so the tenants are the ones really driving that process. I think they do care a lot about it, whether it's for their own internal reporting. I don't have total visibility into their own metrics and kind of what they're, calculating. But I think for us, it's improving our GRESB scores. I think having LEED, we have ESG consultants on every new development. We're looking to develop LEED where we can. So I think it's very important.
Juan, are you also seeing it coming on the tenant side?
Absolutely. I think you're, like Nicole said, your tenants are your partners in this effort. And I think at this point, I don't want to get too high level with this, but I think the general social awareness of the importance of ESG, even beyond sustainability, but also with social and governance issues, it's here to stay. I think anybody that believes otherwise is being unrealistic, and I think tenants really care, especially the larger corporations, obviously, that are being held accountable to public shareholders, but across the board, even smaller mom and pops and regional companies, they're asking us about our intentions, and by showing them that we can be their partner and that we can gather this data and that we can do things together. I think overall it's responding to this increased social awareness to how important this matter is.
And I actually have someone comment, the cost of LEED certification these days are de minimis compared to the value in an energy efficient building in the marketplace. Does that sound, I see you guys nodding along with that.
Yeah, it's coming a lot. It's not that expensive. It's certainly as much as it used to be.
Austin, do you have any more thoughts on this as an investor?
Yeah, I think we are definitely seeing more demand from our underlying tenants. I think you're seeing a lot of pressure from shareholders, stakeholders, of all levels. We're certainly getting more inquiries from our stakeholders about being more sensitive to environmental needs out there. And I think, as Juan indicated too, you're seeing more underlying tenants demanding it. You're seeing, a lot of bad headlines from, how some of these warehouses are treating their workers. So I think that's going to be a driver too, to improve upon, those areas for the sake of the workers.
And I think that's an interesting and important point, that it's not just on the sustainability side, but the broader ESG question as well. What are some of the sort of broader logistic trends that you think investors need to be aware of? And I guess I will ask you, Austin, although you are an investor, so I guess what do you wish you were? Where do you feel like you need to know more, or what's the area where you've really been educating yourself?
I think it's really around, what the end users are. That's probably an area that I'm, because we end up staying, a few steps away from the actual end user. So for me, it's really just trying to understand, getting down to kind of the asset level more. So understanding what the actual end users are needing and demanding is an area that, is is always a challenge for us because we operate in the 30,000 foot level as an LP, and kind of swoop down a little bit once in a while. So making sure I'm understanding, the actual end users, is an area that I'm always trying to improve upon.
And Nicole, what do you think investors really need to be aware of when it comes to investing in this space?
Look, industrial's evolving more so than it ever has, right? And I go back to kind of my initial comments about how what's going on inside the box is changing. So I think now more than ever, it's super important to stay close to your tenants, find out what their pain points are, find out what attributes are most important to them, whether it's power or location or the redundancy in the building, being in close proximity to their vendors and suppliers. Like, what is it for their particular prototype that's driving their need to be in this location? And therefore, how is it making your asset more valuable? Because in a hyper-competitive environment where anyone and everyone has come into the industrial space, it's not getting any cheaper. It's not getting any more difficult to acquire, build, own product, and to remain competitive. I think you have to really understand your tenants, their wants in the most basic form. And I think for us as buyers at this point in the cycle to be really mindful of your basis. I think we heard this on the retail panel, right? But now more than ever, you want to be paying up for the right locations and not the wrong locations.
Juan?
Look, I think as an active investor in the space, we are continually focused on the right match of product and strategy to duration. I think portfolio construction is more critical than ever. Not all investors out there are now looking for IRR and a quick turn on their capital, and I think industrial is actually lending itself very nicely in some of these supply constrained locations to longer durated capital, but that creates another set of challenges as well. Alignment with the manager and alignment of perspective with the manager, and it just opens up a lot of different questions. But not all locations are created equal. The basis is extremely important when it's paired to supply challenges and also potential rent growth in the future. So I would just be very concerned about understanding not just what is my industrial allocation, but what is my industrial allocation according to the type of risk that I'm taking, the type of return that I'm looking for, and the duration of that capital commitment.
And let's hit on that a little bit. What are the main risks, do you think, to watch today and tomorrow? I'll start with you, Juan, and then I'll go around.
Well, look, Austin obviously zeroed in on the one of the ones that we worry the most about, which is supply. I think the ability to quickly add supply in any market is going to be I'm going to quote you, Austin, the ultimate party pooper. So it's definitely something that we look at. I think if you're in a market where supply is not readily being able to be added, then obviously keeping a close tab on how high can rents really go and how high can the price per square foot really go with the core buyers that are looking to buy these longer durated sort of assets, because that's the ultimate exit to a value add investor. And that's very linked with inflation, right? The more pressure we get on inflation and the more upward pressure we get on interest rates, the more I would be watching those potential glass ceilings that might exist that could affect your investment strategy.
Nicole, on the topic of risks?
On the topic of risk, the one part of my portfolio that I'm kind of keeping a really close eye on is turnover and the financial wherewithal of some of the smaller tenants, because I feel like they're the ones who have really been squeezed the most in this inflationary environment, right? You have rising labor costs, you have gas at $6 a gallon and rising transportation costs. Rent in most markets is at historical highs. So at what point for some of these mom and pops or more regional tenants, do the margins just become too compressed? So I think just keeping a really close tab on that, portion of your portfolio is something to be really sensitive to right now.
Austin?
Yeah, and I would just add an area we are paying attention to is just the underwriting and the assumptions and that goes into underwriting when you're buying at really low cap rates. It feels like you can't go wrong right now with the way rents go, but just making sure that those rent assumptions are reasonable, especially exit cap rates. You can move that number around a little bit and have a very different outcome in your underwriting. So just watching that.
And where do you all think, sort of the future opportunities for logistics investment might be as we come, kind of close to the end of the panel? Where do you think the future opportunities are, whether you're talking about a core or a more opportunistic investment? I'll start with you, Nicole.
Look, I think you're going to see us keep developing. I think we've seen great yields in it. I think we've seen great flexibility in what we can do with the design, the depth of users that we can kind of capture early on, later on in the process, depending upon what our development looks like and what market it's in. So I think we're going to continue to develop in the core markets. Again, be really mindful of labor going forward. These anecdotes that we're hearing are real. I don't think we're going to be able to automate facilities in any kind of a meaningful way. I think they'll work hand in hand with human labor, but we're not going to ever, I don't see ourselves in fully robotic facilities anytime soon. So really, being sensitive to that labor supply and following the labor. And if it's going to secondary markets, I think that's somewhere where we want to be looking and looking to maybe, make a mark in.
And what?
Look, I think it's sort of a two-pronged approach for us. I think on the one hand, continue to be laser focused on these really supply constrained areas, aggregating what we think is a compelling portfolio of infill assets that will continue to experience rent growth. We think that overall that's a very attractive investment strategy that we see a little bit of runway on. And then also development. I agree with Nicole. I think as long as you can find where the data is and where the expansion that makes sense, where you have some level of supply constraint, you're going to get attractive yields doing development. You're just going to have to be able to navigate the entitlement risk and be able to find the sites so that you can put the buildings up.
And I'm going to go over to Austin. Where are you seeing future opportunity for investment?
Yeah, I mean, same thing that Nicole and Wanda said, infill primarily for long-term holds, selective development where you can get an additional yield and actually get the product built. And then also just looking at, but I guess more broadly would be looking at markets that, have growth opportunities. I think some of the East Coast ports, is an area that on our portfolio, we're probably underweight to. So those are some areas that as we try to keep ourselves well diversified, looking at areas that we don't have full exposure to, and try to build out some of those locations.
The sun coming in behind you,
Yeah.
you're disappearing. You're exposed. But I do want to give you a chance to share what your maybe key takeaway might be, Austin, for our audience.
So I guess where we're focused, or where we're trying to keep ourselves mindful is really the long term. Trying to keep ourselves realizing that in a bull market like this for industrial, you can do no wrong at the moment, seemingly, but recognizing that at some point, I do believe a return to the mean, and at some point, certainly not in the near term, but at some point you will. So we're trying to be mindful of some assets maybe we've held that maybe haven't seen the same kind of growth, or on the downside, it's a great time to be a seller if you want to churn your portfolio a little bit to create, to kind of get rid of some of those lesser performing assets or markets that you want to maybe be outside of once the market does, settle a little bit.
Juan, what might be one of your key takeaways for our audience?
Not all industrial is created equal, and just because it's logistics doesn't mean that it's a great asset to hold long term. And I think really zeroing in on the fundamentals and taking a holistic approach to investing, not only on the fundamentals of the real estate, but understanding the importance of ESG across the board, and It's just, I just feel like we're no longer in an investment environment in general where you can be narrow in your focus. You need to really understand that it's holistic, and hopefully everybody does well.
And Nicole, key takeaway.
Yeah, no, I'm with Juan. I think it's diversity within your portfolio. I think it's staying really on top of trends and being relevant within industrial, given its, evolution. If all of a sudden we experience this renaissance in onshoring and manufacturing comes back in a really meaningful way, do we own product in the right markets that can accommodate, capturing a diverse manufacturing base? Do we have the distribution and fulfillment product that's, 4 stories high and 40-foot clear in the right, markets to capture that end of the e-fulfillment? Do we have the deep infill final mile facilities in there as well? It's that diversification within your portfolio, and I think it's going to over time mitigate risk, help push your returns. And as you scale up, right, we're I think up to 200 million square feet across the country nationally. Can I accommodate users, growing within my own portfolio, growing in multi-markets across the country with us, as a landlord? Is that something that we're able to offer? I think is something that we're going to be really, just focused on continuing to do in 2022.
Well, I would like to thank all of the speakers.
Thank you.
Thank you. I'd like to also thank all of the speakers on all 3 panels today. I'd like to thank our sponsors. Once again, that's Clarion Partners, Elian, Equus Capital Partners, Hines, Prologis, and TA Realty. I'd like to thank all of our attendees for joining us today as well and submitting some really great questions. We'll be sharing a video link to this webinar for all the attendees, so you should be able to replay any parts if you like. This has been a really great conversation looking at how logistics and retail, how they fit together, what's similar, what's different. And the IREI Live webinar series will continue next year, digging into some topics in the same sort of depth with industry experts. So please watch for updates for new topics in 2022. Thank you all, and goodbye.